Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. It's my pleasure to bring you this first in a series of videos illustrating the stealth bear market that I see manifesting in dividend-paying stocks. Today's featured dividend-paying stock is General Mills, Inc., packaged foods and meats, but best known for their cereals. And what I want to really focus on here is the operating earnings to start with. And what you see here, this orange line is a PE ratio of 15, or it's 15 times each of their year's earnings. But what I'd really like to focus your attention on is the change per year or growth rate of earnings that this company has achieved each year. And I want you to notice that growth was pretty high during this period, but if you look at what's been going on since, let's say, 2011, you'll see that the earnings growth rate has slowed down quite a bit. So we've got an earnings growth rate of 7.4% going back since 1999. But as I chop time off of this graph, you'll notice that the growth rate now has dropped to 5.4% since 2006. If I drop some more years off, you see now the earnings growth rate is 3.5%. So what's been happening here is the earnings growth rate has been dropping. Now I'm going to chop one more year off of here, and we now have a 3% growth rate since 2012. Now I'm going through 2017, which are actual data points, and then I've got estimates for 2018, 19, and 20. So I'm going to bring a few more elements into the graph now just to give you some greater perspective. The second would be the dividends and the dividend payout ratio. You can see that their dividend record is good. Now, long term, there have been some periods where they've frozen the dividend, which I'll show later, but they've got a good dividend growth rate. They currently yield 4.6%. That's a function of valuation, as I'll illustrate in a moment. Their current blended PE ratio is 13.8. They have a BBB credit rating and 50% debt to capital. Now, the dividends below this white line is the amount of dividends that they pay out to their shareholders. So I'm going to take this section of dividends and stack it on top of the graph now. So now you have the dividends while they belong to the company. You have the dividends after they've been paid out to the shareholders. And what I'm going to add next are monthly closing stock prices. And this is important because, again, I want you to focus on the dividend growth rate here. When I put the price, the monthly closing prices onto this graph, I want you to see a period of time here where the price was tracking the orange line, which is a fair valuation reference line. And then we had high valuations, PEs of 18, 19, 17, 19 and a half, and then it peaked where the PE got up to 24.4. And then since this time, as I indicated in the written portion of this article, since July of 2016, General Mills stock price has fallen over 40%. The capital appreciation or depreciation was negative 41%. Now, they did pay you a nice dividend over this period of time, but had you invested $10,000 on this day, July 29th, 2016, your dividends would have been $490, but your capital loss would have taken $10,000 to $5,882. That's an annualized negative rate of return of 22% a year. But here's the thrust of this particular presentation. Nothing has really changed with the company. The fundamentals are still the same. They did make a big acquisition, but the point is, with this high valuation, which was really unjustified by, in my view, by a relatively low growth rate, but the earnings growth is expected to continue to grow at approximately those same rates, and I'll get into that in a moment. So what you have here is simply a period of time where you had irrational exuberance in this stock, and now we've got some negative stocks. So now, as a result of the price falling down, if I put the year-end dividend yields, you can see, and by the way, this has a fiscal year end of May, interesting. So their May 31st, 2018 yield right now is running at approximately 4.6%. We're obviously not quite there yet, but that's where it's sitting today. The yield is 4.6%. That's the highest yield we've seen over this time frame. But let me expand the graph and let me go back to 15 years, which includes estimate data. And you can see now we have a very high yield, over 4%. When even during the Great Recession, when the PE got down to 12.9, General Mills was only offering a yield of 3.4%. So this high yield is a function of a couple of things. I want you to notice, if you look at this graph closely here, that their payout ratio has increased over this period of time. And let's go ahead and look at that by looking at the historical performance results. You can see that the company was routinely paying out in the 40%, 40 to 45 to up to 50% of their dividends. In the last 2 years, they've increased that payout ratio to over 60%. but their dividend has grown at almost 10% a year on average, or the compounded annual growth rate are identical in this case at about 9.9% over this time frame. Now, they have produced substantially more dividend income than the S&P, but they've underperformed it on a capital appreciation. And of course, to me, that's very clear. Even though the company was attractively valued here, and it's moderately undervalued today, what's happened is we've had this bear market. Bear market's a correction of 20% or more. If you look at just this calendar year, since December 29th of 2017 to yesterday's closing stock price, General Mills has fallen almost 29%, which is by definition a bear market. So we have over a 40% drop since July of 2016, and now we have actually a 27% drop this calendar year alone. But to me, and I hope it's clear to the viewer here, that this can all be attributed to this overvaluation period that we had here. Now let's go ahead and expand this out and look at it longer term. And what I want you to notice is that price has gone where the earnings line has gone. Now, there have been times of overvaluation. We had overvaluation in 2001. These periods of overvaluation always lead to weak performance. Even here, if I measure the time frame from this period to this period, we see that you actually had a negative compounded rate of return over almost a 4-year period there. Valuation is so important, I can't stress it enough. Then we had undervaluation in the Great Recession, where the PE got down to 12.9, which is just a little lower than what we currently have it. And even at today's low valuation, you ended up making 9% owning this blue chip dividend paying stock. But of course, if you'd have measured it and got lucky and sold it at the peak, your rate of return would have been over 17%. But the main point I want to make with this video is simply this. Here's a case where this valuation was unjustified. Nothing really happened here. In fact, if anything happened, the earnings growth was slowing down. They did increase their payout ratio a little bit, but there was really no reason why the market was valuing this stock so highly other than because it said so. The market was simply putting a high PE. If I put the normal PE ratio calculation here, it was routine for the market to value General Mills at about an 18.8 PE, and of course today it's at 13.8. But this was an inevitability, and this is what's insidious about valuation. We had a very long period here, 3.5, 4 years, if you will, where valuation stayed extended, and that lulls investors to sleep, in my opinion. But in reality, at the end of the day, the reversion to the mean, as some people like to call it, is going to occur. You can see somewhere between a 15 and a 17 PE ratio over this time frame is normal. And you can give it because it's a dividend payer and has high yield, a premium valuation to maybe what the formula says the orange line would say that the company is worth. But there's no reason for this justified valuation. But here's what's interesting to me. Even though the price has fallen so dramatically, nothing's really changing with the company. Let's go ahead and look at estimates for a moment, where we have a rather large following of analysts. A consensus of 21 analysts expect this year to be a negative growth rate. Now, of course, that can partially explain why we've had this drop in valuation. This is fiscal year data here. This is May of 17 to May of 2018 when this company reports again. But earnings growth is expected to be 3% next year and 1.9%, if you will, for 2020. Now, if I look out longer, if I switch to a trendline growth rate that analysts expect, I've only got one analyst, but there are analysts that think the General Mills is going to go back to an 8% growth rate. Now, the point I want to make is, though, nothing has really fundamentally changed with this business except the valuation. The valuation was too high. It's now become reasonable. Now, what I'm looking at here is just the fundamental data based on earnings and operating results. Let's look at some of the other metrics because this is a dividend-paying stock. Let's look at operating cash flow. And let's do a valuation of General Mills based on operating cash flow. Now, what we see here with this graph is this company normally trades at about 13 times operating cash flow. That's the blue line in this case. And it's currently trading at 9.6. So on an operating cash flow point of view, it's very undervalued relative to historical norms. But the point is, the operating cash flows are clearly covering the dividend. But now let's move to free cash flow. Now I'm going to take price off the graph when I look at free cash flow, because I don't use free cash flow as a valuation metric. I use free cash flow to determine whether the dividend is being covered or not. And the company has always covered their dividend with free cash flow. Got a little dicey we had a pretty high payout ratio of free cash flow in fiscal year ending 2011. Let's go ahead and look at that down here. You can see that the payout ratio of free cash flow got up to 80%, and more recently it's been running about 55% versus its normal 45%. But the real key here is they are generating free cash flow, and their dividend, in my opinion, is extremely well covered and currently safe. So the bottom line of this presentation is simply this. General Mills is a good dividend paying stock. They have a good long-term record. Let's examine their long-term dividend record. I want you to notice that coming into the Great Recession of '01, the company did freeze their dividend for several years. They froze it, in '01, '02, '03, and '04. But then since that time, the dividend has grown quite nicely, and it's been averaging 7% over this time frame. But you can see the individual growth rates here. The payout ratio has expanded. So to me, this is a reasonably valued or attractively valued dividend growth stock, at least over the last 8 or 10 years, with a significantly above average yield, 4.6% currently if you bought the stock today. So if you're a long-term investor looking for a good income paying stock, I think General Mills might fit the bill. But I also want you to notice that this bear market in dividend growth stocks is starting. General Mills is just one example. We had these very high valuations. Now, some of that can be attributed to the fact that interest rates have fallen. So this is our PE interest rate graph, and you can see since February of 2000, the 10-year Treasury was yielding 6.68, and it's now yielding close to 3. But we also had periods where it got down to like a 1.5% rate in 2016. That made bonds less competitive with stocks, which might partially explain this high valuation. But regardless, I would argue that the stock was never worth this kind of valuation, and now we're seeing that reversion to the mean finally occurring. This is Chuck Carnevale. I hope you enjoyed this first in a series of articles illustrating the beginning of what I consider to be, I'm calling it a stealth bear market currently, but a bear market in certain dividend growth stocks. There's a lot of dividend growth stocks that are still overvalued, like General Mills was in 2016. But as I'll show you with the rest of the series of these articles, there's a lot of dividend growth stocks that are starting to look attractive again from a valuation perspective. This is Chuck Carnevale saying thanks for watching.